Regulation of Financial Markets and Institutions, Part 2. Some of the major regulations that govern financial institutions include the Emergency Economic Stabilization Act of 2008. This act allowed the federal government to purchase and bail out banks and financial institutions that were at the risk of bankruptcy. The Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010. This act created the Consumer Financial Protection Bureau to enforce consumer laws. It also established new regulations of how customer data is collected, managed, and reviewed. The Federal Deposit Insurance Corporation, or FDIC, is an independent agency that insures deposits in U.S. banks and thrifts in the event of a bank failure. What it insures. The FDIC currently insures deposits up to $250,000 per depositor, including checking and savings accounts, certificates of deposits, money market accounts, IRAs, and employee benefit plans. How it's funded. Member banks pay into a special insurance pool to fund the FDIC's insurance. What it's meant to do. The FDIC was created to help boost confidence among consumers about the health of the nation's financial system. When it was established. The FDIC was established in 1933 as part of the Emergency Banking Act. The Glass-Steagall Act of 1933 was a landmark banking law that separated commercial and investment banking activities. The act was a response to the 1929 stock market crash and the wave of bank failures that followed. The act's purpose was to protect depositors from potential losses by preventing banks from using their funds for speculative operations. The Glass-Steagall Act was part of the New Deal and was signed into law by President Franklin D. Roosevelt in June of 1933. The act's key features include separating banking and brokerage activities. The act prohibited banks from operating as both a bank and a brokerage. Creating the Federal Deposit Insurance Corporation, or FDIC, the FDIC again guarantees individual deposits. Limiting banks' investments in stocks. National banks and state chartered banks were limited to buying and selling securities as agents. The Glass-Steagall Act was repealed in 1999 by the Gramm-Leach-Bliley Act, which eliminated restrictions on affiliations between commercial and investment banks. Some argue that this repeal contributed to the 2008 financial crisis. The Glass-Steagall Act was created to separate commercial banking from investment banking after the 1929 stock market crash, aiming to protect depositors from the risks associated with speculative investment activities by preventing banks from engaging in both simultaneously. While the Gramm-Leach-Bliley Act repealed major parts of Glass-Steagall, allowing banks to merge with securities and insurance companies, essentially creating universal banks that could offer a wider range of financial services, a move that some argued did contribute to the 2008 financial crisis by increasing systemic risk. Key points about Glass-Steagall and Gramm-Leach-Bliley. Glass-Steagall's purpose was to prevent the risky practices of investment banking from jeopardizing the stability of commercial banking by creating a clear and distinct division between the two. Impact of Gramm-Leach-Bliley. By repealing Glass-Steagall restrictions, it allowed banks to engage in both commercial and investment banking activities, leading to increased financial conglomeration.